Hello to our global audience. My name is Emily Whitehouse, Associate Director of Admissions for the Master's Degree Program in Asset Management at the Yale School of Management. Our session today features Professor Tobias Moskowitz and Lauren Kaplan, who will be in conversation about asset management in an uncertain regulatory environment. Hello and welcome to you both. Good morning, Lauren. Good morning, Toby.
Hey, thanks for having me.
Good morning.
Great, and so I'll briefly offer some background on both of our panelists for today. Of course, many of you already know Professor Tobias Moskowitz, who is one of our faculty at Yale SOM and our faculty program director for the asset management program, also principal at AQR Capital Management here in Connecticut. And Lauren is Associate General Counsel in Yale's Office of the General Counsel and primarily supports the Investments Office. Lauren's experience includes investment management, securities, regulatory, and nonprofit law, and she has advised a wide range of companies, including endowments and foundations, investment advisors, startup and early stage companies in both traditional and social enterprise sectors. Prior to her appointment at Yale, Lauren served as general counsel to a startup providing alternative financing mechanisms in the renewable energy sector. Lauren has always been interested in cross-sector solutions to the most pressing challenges and has written several articles on the topic, including regulating the levers of globalization, integrating CSR into capital raising process. Lauren holds an AB in government from Harvard College and a JD from Georgetown University Law Center. Professor Moskowitz and Lauren Kaplan will be conversing on a number of topics, and some of your pre-submitted questions will be covered here. If any other questions come up for you, and I hope they do during our Q&A session, we hope that you will use the Q&A function to submit them. And without further ado, I will go ahead and turn it over to Toby.
Thanks, Emily. Thanks, everyone, for joining us this morning or this evening, depending on where you are. Lauren, thank you for being with us. So it's really great to have you. One thing I want to say before I'm going to let Lauren speak most of the time, and I'll ask some questions, is we're really grateful in the program to have a course like Lauren's. One of the things that we try to do with the curriculum at the asset management program is provide something that's totally different than anything else that's out there. And one of the big pieces is having courses like Lauren's that touch on the regulatory environment and how it's evolving and some of the new topics in that area, which you don't typically get from these programs. And this is really important stuff for the asset management industry. In fact, it's becoming increasingly important, as I'm sure we'll talk about. So one of the unique features is having partnering with the Yale Investment Office and other people in practice who know this stuff, and the fact that they're able to teach on campus is really great. So Lauren, thank you. I'm going to start off with an easy one, which is, can you tell us just a little bit of, about your career and your current job and what occupies your time these days in particular?
Sure. Well, Toby, thank you so much for having me, and I'm excited to be doing this course and to participate in the program. It's gonna be a lot of fun, and looking forward to talking today as well. So I started out in nonprofits early on in my career, and it was sort of at the time when venture philanthropy was just at the very beginning stages where people were starting to, look at private sector tools and how you might apply them to nonprofits. And that's really where I first became interested in kind of working across sectors to come up with solutions to various challenges. And from there, I went to, I did some policy work in DC, and then I went to law school and still had this interest in cross-sector work, but really wanted to understand more kind of the private sector side of things. Went to work at a law firm, did work on project finance and corporate work in New York and London, which was a great experience because a lot of the project finance work sort of had implications around, or again, early stages of ESG considerations and kind of that thinking. And then when I came back from London, was really fortunate to find Common Fund, which was this great combination of all of my sort of areas of interest. It was a nonprofit itself. It's all of its clients are nonprofits, but in many ways it sort of was functioning and functions today like a mainstream investment manager. And so I went to Common Fund, which is really where I got my training in investment management. I was there for 8 years. And Common Fund was a great place to learn about investment management because we are a fund of funds and sort of sat right in the middle. So we both were, organizing and running our own investment funds as well as investing with other managers. And so we were sort of on every side of that. And we had registered investment advisors, broker-dealer, and we also did outsourced CIO work. So it was a great place to kind of come up in investment management. And then from there, I again still had this interest in kind of cross-sector issues and became involved at Common Fund in sort of more deep work on ESG as our clients became more interested. Went to do a little impact investing, like Emily mentioned, at a sort of energy finance startup that was using a public-private model. Did that for a little while and then was so lucky to end up at Yale, which when I was at Common Fund, I was lucky to have some chances to come to SOM. Common Fund ran an endowment institute during the summer at SOM. We worked on the low carbon case study at SOM, which was a great experience. So I was excited about the opportunity to come and be a part of the investment office and to be at Yale and be able to contribute to university. So, and today, a lot of my work focuses on just the endowment, the endowment's core work. So looking at our managers and sort of negotiating those investments. And then more broadly, have an opportunity to get involved in some work around the carbon offsets work that Yale is doing. So it's a great mix of different projects to work on.
That's great. So, I was going to talk about, what drew you to Yale, but I think we already covered some of that ground. And obviously it's a world-renowned endowment investment office and, led by David Swenson for many years and obviously great people there. We're thrilled to partner with them. But I want to talk a bit about the course you're going to teach this spring, which is, just so everybody knows who's on the call, it's a brand new course. It's actually when Lauren sent the syllabus in, myself and my colleague Heather Tukes took a look at it. We're like, we kind of want to take this course. We don't know any of this stuff. This looks really interesting. So with that setup, high expectations. Let's start with just what do you hope students will take away from your class? And if you want to talk a bit about what you hope to do in the course.
Sure. And thank you for the opportunity to do the course. I'm very excited. I think that, the idea of the course is one, to just provide a baseline understanding of the regulatory environment, the architecture that asset managers operate in. There are overlapping regulators. It can be a complicated structure. So the beginning idea is just provide a baseline so that those involved in asset management, whether at an institutional investor setting like an endowment or foundation, or at an investment advisor or a fund, in any of those settings, to provide a baseline understanding. But then the bulk of the class is really about understanding that the regulations that are in place, often lag emerging investment strategies. And so when you're on the ground trying to implement those strategies, how do you deal with that? You don't want to you can either be sort of feel constrained because the regulations don't fit and you don't quite know what to do about that, or you can go the other direction, which is sort of just working sort of ahead of the regulations, and that can be difficult too. So the idea of the course is to basically, by going through very specific emerging strategies right now as kind of case studies, go through those and talk about, what is the current state of regulations, where are those regulations in tension with those emerging strategies, and how might you, if you are implementing those strategies, how might you do that? How do you work in those kind of developing areas of regulation so that you can be nimble and you can take advantage of new strategies, whether it's, looking at crypto, everything going on around ESG, SPACs, There's a lot of kind of hot topics right now that are the subject of, regulators' focus, but the regulations haven't quite gotten clarity for those who are on the ground trying to implement. And, we're going to look at those topics by bringing in experts who are on the ground trying to implement these strategies. So, in the crypto space, we have Reba Beeson coming in, who's the general counsel of a group that basically provides the back operational support for crypto platforms. And she can talk about exactly what they're struggling with. They're right in the middle of a lot of these regulatory questions. We have people, Deborah Spalding, who's at Common Fund now, but was the head of the Connecticut Pension Fund for many years and runs the outsourced CIO program. With Tim Yates, who's also coming. They're going to come in and talk about ESG and kind of the challenges there. We have people from the Yale Investment Office coming in to talk about changing regulatory climate in China. So, we're going to try to bring in the people who are on the ground, who are having to do this every day. So the hope would be that students would come away from the course with a lot more comfort in how to deal with those situations and kind of a little bit more trust in their judgment. And because a lot of these are judgment calls when you're on the ground trying to figure out what you can do and how to do it.
So I want a couple of things I want to touch on that you said. I mean, you can see, I hope everyone can see why a bunch of us want to take the course too. So I may sit in on it, for instance. But one of the things I think you touched on was your course on particularly on the regulatory front has a very much an international focus, right? The Yale Investments Office is invested all over the world, right? In many different asset classes in many different regions. And I think, a lot of the regulatory courses that you typically see at a university, particularly in a law school, they're very US focused, but that's not going to be the case with your course, right? I mean, what you deal with every day is not just the US regulatory landscape, which is complicated enough, but, I don't even know how many countries you have to deal with. But do you mind talking a bit about that as well?
Sure. Yeah, I think we will look globally. We'll also sort of, we have to think about where is most of the capital raised. And so we will, there will be a lot of US work, but we will look globally as well, because like you said, everything that we're doing in our office and, that many asset managers are dealing with these days there are implications, not just in the US markets, but globally. So we will look, for instance, even in ESG and all of the requirements right now that are coming down the pike around disclosure from companies and marketing of private funds. Those regulations there are things happening in the US. There's a lot happening in the EU and the UK. There's a lot happening, in other jurisdictions as well. So yeah, we will definitely take kind of a global perspective on some of these issues, and also try to develop a bit of a better feel for, how some of these issues are viewed differently. And then what do you kind of do about that when you're trying to put a portfolio together that has exposure across the board, and you're trying to develop your viewpoint as well on some of these issues. So.
Yeah, and that raises another question, which is, and then one that I deal with at AQR as well, which is how closely do you work with portfolio managers? I mean, as you said, it's, portfolio manager wants to do what they want to do, but they have to operate within the constraints of not just the current regulation that exists. That's a bit easier, but how to navigate this, anticipatory regulation, right? So like you said, it's evolving. It's typically lagging the investment strategy, and your job, I assume, is to sort of protect, in this case, the endowment from any liability or exposure or even just cost that's going to come down the road from this. So how do you do that? I'm curious myself, because I see it happen at AQR. It's tough, right?
Yeah. Well, I can speak a little bit to that, and then I would say, it'll be great to hear from the investment team folks who will come to the class, who are the experts, who are having the conversations more than I am. But I can say that, they are, investment team members are in constant conversation with our managers, right, about these issues, and developing a viewpoint, both within our office, but also understanding better, what the manager's viewpoint is as like regulatory climate develops. And the nice thing about our model or common funds model, where you're investing and partnering with a lot of managers, or any advisor who's doing that, is that you get a lot of different viewpoints on some of these things, right? So if you have exposure to China, for instance, and you're working with a number of managers, that's a nice, you have a number of kind of sources of views of what's going on that can then help you inform your own view, which then when you're thinking about your portfolio as a whole, is going to help you think about how to put the different pieces of it together. But I think I'm getting out of my depth, so I think I should leave it to the investment.
I'm sorry.
No. They can definitely talk more in the class about those types of conversations and how they manage that.
Yeah, no, and I love that. I love that, bringing people who do this for a living to campus, who have to think about this every day is really great. So one of the things that you and I have talked about actually, and something that I think is sort of interesting is also thinking about how to maybe even potentially help guide or influence regulation from the perspective of, take cryptocurrency, right? I think the regulators are struggling with what to do. And so, I don't know how much of this is a part of your job, but sitting at Yale, where you have the potential to have some influence or some say in, hey, we've thought about this issue, and here are some policies, some suggestions of things that would help. That's something that I think, you're going to, big asset management firms typically try to deal with, which is to try to, create regulation that's useful, right? That satisfies. So how much of that do you think about, or do you do at Yale, or work with people to do at Yale?
Well, thanks for bringing that up, because I forgot to talk about that actually in the context of the course too, because that is, another part of what we really want to cover in the class. Is this is sort of how do you engage with the regulation making process, right? And so, like, one of the large projects in the class is going to be looking at topics that are currently under open comment period, and what would it be like to sort of submit comments, and how do you think about that, and how can you be useful? Because, like you said, I think a lot of these strategies are complicated. And so for the, for the regulators trying to figure out there might be an overarching policy goal that everyone agrees to, or some subset agree to, as the overarching goal, but then you've got to understand really the details on the ground to write regulations that work. And that can be a big challenge. And that's where I think, participants in the asset management field can be really helpful. And it ends up, like you said, benefiting everybody, because it's just clearer guidelines that work. So we're definitely going to spend time working on that. And, during Dodd-Frank, I remember being at a fund of fund, there were a lot of regulations that came down that just didn't fit. They just didn't, they were going to end up in the regulators getting like the same information 3 times, and didn't make sense because they weren't, they didn't quite fit this situation, and they just hadn't thought about it, or just hadn't been able to kind of customize. And so, even back then, I remember having to work through that and having to communicate with the regulators to say, like, we don't think this is what you want, but we want to comply, and kind of working through with them. And, for the most part, obviously they want the regulations to work. So I think, that is another part of what we really want to focus on, is how do you engage in that process? When do you engage in that process? There's times when it makes sense, and maybe times when it doesn't. But
yeah, because my experience has been similar, which is regulators do want to get the goal done, and then they struggle with how best to do it. And so they look for, certainly asset managers who can be helpful in terms of guiding it. And yes, you always have to worry about self-interest and all that. But like you said, there's things like, well, in fact, I'll bring this up now. Let's take ESG, for instance, which I imagine is a topic, well, you've certainly spent a career on, and something that is currently a very big topic. We can all agree that we want to reduce, let's say, our carbon footprint. The big question is how to do that. So are there things in that space that you think are super interesting right now, or things that you're dealing with?
Yeah, I think, one of the challenges, and this has been a challenge for years in the space, but it still is the big challenge, is there are so many standards, reporting standards, that are voluntary, right? But so many different ways that a company can report on ESG factors. And it's still difficult to compare that information, and for that information to be meaningful for investors who, are interested in those issues, and they want to, think about how those are reflected in their portfolio. But, I think as the SEC is really focused on this issue and looks at, mandating more and more reporting, that challenge just comes into focus even more, because when you mandate reporting, if the reporting structure is still not clear enough, you're not going to get, good information. And I think there was a requirement maybe last year put in place on like human capital reporting. But then I had seen a law firm had looked at like 450 companies who submitted the required reporting, and the information was like not uniform, not comparable, and so really not useful. So I think one of the challenges is still this this idea of getting the right type of disclosure, and getting meaningful disclosure on these topics. And for the E, some parts of the E, it's easier to get clear on how to do the disclosure or to quantify it. Some parts it's much harder. The S can be very difficult to come up with how to do reporting where you can compare, because those issues are just not quantifiable a lot of times,
Right.
or harder to quantify. So I think some of the challenges are really just still on getting the right information, and doing it in a way that companies also feel like they are clear on what they're supposed to be reporting. Because I think a lot of companies are like a million standards, which one do I use? And it can be a challenge for them as well. So I think that's a big issue. A long time ago, I had looked at accounting standards as a way to get at this. And SASB came along, which was, on that idea of how do you sector by sector define which ESG issues are material, and just focus on those material issues as what would be required to be disclosed. I think that's still a good model, but there are a lot of things going on in this area still, hopefully with a lot of people focusing on the measurement and the ratings. I think the other part is there are various groups, right, that provide ratings on ESG issues. But again, if you dig down into what they're doing, they each have their own process for doing it. They each count different activities differently. So, I remember even there were differences between how one of those ratings groups would count if a company just didn't report on a particular factor. One would ding the company, one would leave it neutral or something. And then, but you need to understand that. So for investors and managers in the space, I think those are all challenges that are still out there.
Yeah, and I think ESG is such a fascinating topic because it sort of covers all the grounds you're talking about. It's an ever-evolving regulation landscape. The regulatory agencies are not sure what to do, and measurement's a problem. And so you have the potential to influence things as well as you have to respond to things. But I can see why you've spent a good part of your career thinking about it. It's a tough problem. In addition to ESG, though, what do you see as the other big regulatory issues that you're grappling with these days?
Well, I think you mentioned crypto, which is, a huge one. And I saw there's actually I think there's a hearing today in the House on crypto, bringing a bunch of crypto CEOs to the Hill to testify, to try to help lawmakers understand more what's going on. But, I think that's a big area because one, it's growing, right? It's not as small. It's, I think, $2 trillion of assets are in crypto at this point. So it's not a nothing area anymore. It's significant. And, there's lots of opportunity there, but there's so much lack of clarity in terms of the regulatory status, whether you're talking about cryptocurrencies and tokens, or whether you're talking about the platforms, on which crypto is being traded. I think It's a big focus of the SEC. You know, they've said they're going to come out with rules. I think, you know, the chairman has said in some circumstances, he absolutely views crypto tokens as securities. But there's another school of thought that they're really more like a payment mechanism. They're more, they more fall within that rubric, and maybe they'd be subject to banking regulations. There's also a thought about them being commodities. So those all have different implications. And then the platforms themselves, again, you know, are securities being traded on those platforms? Do they need to be registered in that way? So I think there's just a lot to be worked out in that area, but a lot of exciting opportunity going on as well. And so for a manager who wants to be in the space, trying to figure out right now kind of how to think about that is an area that I think is worth a lot of focus, and we'll spend a bunch of time talking about.
Oh, that sounds super interesting. So, and you know, I'm sort of curious, and some of the other students are as well. You know, this asset management program is, you know, we're going to have some students that go into the hedge fund world, some into endowment and nonprofits. Do you view the regulatory issues in some sense are the same, but they're also how you handle these may be very different. I don't know what what you do at Yale. How different was that? I guess Common Fund was not too dissimilar, but in many ways, you know, it's a different business, of course, right? So,
yeah, I think it's a good question. I think, you know, if you're at an asset manager who is managing funds for clients, multiple clients, you are going to have a lot more compliance obligations. You will be subject to the kind of regulatory climate in a different way than if you are kind of internal managing assets for your own institution, so an endowment or a foundation. So for example, you know, if you're at an investment advisor, if you're a registered investment advisor, you're going to have a whole slew of reporting requirements and just a framework within which you need to operate. If you are a broker dealer, you're going to have another set of regulatory obligations. If you're selling interest in funds, that's going to implicate a whole other set of requirements versus if you are at an institutional investor making investments. Then I think a lot of your regulatory kind of focus and work is going to be a bit more around the investment strategies themselves and how the regulations impact those strategies. So, you know, you won't have as much on kind of the compliance side or your operations side and those types of requirements, but you still will very much need to understand and be thinking about the regulatory climate for the strategies that you or your managers are implementing.
Yeah, no, that's super interesting. I at AQR, where we do have lots of clients, the compliance component is a big part of it.
I'm sure.
Yeah, exactly. And that sort of leads me to my last question before we open it up to everybody, which is, throughout your career, you've seen how the importance of compliance and regulatory oversight has evolved. My sense is that its importance has been ever increasing over time, but I want to see what you think. But I want to stress to the future asset managers who are here on this call with us just how important this stuff really is, because it's really a big part of the industry.
Yeah. I mean, my experience definitely is consistent with what you're saying. It has grown an awful lot. And one of my colleagues had put together at Common Fund, actually around when Dodd-Frank came in, he had put together a chart that charted the number of compliance filings that he had to do, every month and how it had grown. And it was, it had like way up astronomical. And, there's a discussion to be had about, has that led to better things or not? But there has, definitely on the compliance side, I think the obligations and the requirements have grown a lot. Part of that is because the types of strategies and instruments and tools being used have become a lot more complex. And so the regulations have tried to cover that, right? And they've become more complicated too, to try to, to try to allow for those. Because I think the overarching idea of, especially in the US, of regulation of these markets is, not so prescriptive, but more just make sure the disclosure is there, make sure the playing field is fair, and make sure there's nothing kind of illegal going on. But other than that, wanting to create an environment that, does support innovation in strategies. And so I think, that's still the idea. And so as all these new strategies come down, the regulations have kind of, become a bit more complicated to try to cover all that while still allowing for it.
And this is not just the US where this has exploded, right? I mean, you see it all over the world as well, right?
Yeah, yep. I mean, in the EU, we had the alternative investment regulatory structure come in a number of years ago, which has taken years to implement, and kind of reworked how managers both within the EU, between member states, could do offerings, and how they had to operate, and how managers coming in from outside could operate. There's even, on the kind of data side, the GDPR in the EU has completely, upended a lot of sectors, but has had an impact on, managers as well, because it's very far reaching in terms of what's included in data. So yeah, absolutely. Kind of all of these areas, not just in the US, have kind of exploded.
Interesting. Well, I want to be conscious of time and give the students, the prospective students, a chance to ask some questions. So I think, Emily will open it up if there's any questions. If not, I'm sure there will be, but if not, I have a few.
Yeah, so just to start, and kind of piggybacking off of what you were just discussing, kind of the global implications, we had one question come in regarding the regulatory environment in China. The writer is saying that it's becoming increasingly complicated with antitrust and social equity, data security, an aging population, domestic independence, carbon neutrality, etc. Curious on your view about navigating policy in China.
Agree. Very complicated. There's a lot there and a lot in that question. Yeah, I think honestly, like every place, we need to keep asking questions, understanding what is going on the ground, understanding the thinking behind a lot of these policy changes. Obviously, right now there's a lot going on in terms of, the actions around Chinese technology companies listing on foreign exchanges. There was recently, the issue of DD divesting from the New York Stock Exchange. So there's a lot going on around kind of particular sectors, and how China is thinking about that. And then on the US end, also thinking about our interaction with not just Chinese companies, but non-US companies listing, and requirements around, being subject to our audit requirements and things like that. So there's a lot going on, kind of cross-border considerations in terms of these markets. In China itself, I think like the question said, which is a great question, there are so many different pressures and trends. So, and all of these issues kind of are related, right? So we were talking about crypto before. I think like 90% of the crypto miners are in China. And there are a lot of concerns around crypto and ESG in terms of the energy requirements of those mining operations. And I was looking the other day, and it looked like, I think the mining was in a region of China that was very coal dependent. China has now switched that to a region that is powered more by hydropower. And they did that because they are, concerned with they have their own carbon emissions reductions goals as a country. And they saw what was going on with the crypto mining and switched it to an area that was, not backed by coal, partly because of their carbon goals. So all of these issues are interrelated. So it's a really interesting place to be looking at and to be thinking about. But yeah, I think the approach is to just look at all the connections, try to understand the context, and stay informed and keep having conversations with those on the ground as well.
Great, thank you so much for that. And another question we got relates to SPACs, saying they become very significant in 2021. And do you see or envision regulatory inputs among SPACs specifically?
Yep, good question. Yeah, I think SPACs are definitely an area that have been identified as an area of focus for the SEC this year in their priorities as well. So I think we are going to get some more rules that come down next year around SPACs. And I think some of the concerns there are just making sure, one, that disclosures are accurate, since these are sort of, started without the target companies defined. You want to make sure that disclosures to investors coming in are clear. And then there are some inherent conflicts in the SPAC structure that the SEC is concerned about in terms of one, the sponsors of the SPACs and their sort of interests once the mergers with the target companies occur, and also the roles of banks who are sort of involved both at the start of the SPAC and then in the merger portion. So there are some really interesting questions that the regulators are focused on, and I think we will see some more rules come out next year.
Great, thank you. And so one other question, I don't know how deeply you can get into specifics, but inquiring minds seem to want to know. Could you talk about an investment opportunity you saw in the past, but was turned down due to certain regulations?
So I do need to sort of punt on that one, just because, again, I'm the lawyer, not the investment professional. So I don't think I'm in the best position to talk about it, but we will find those that are if you take the class, and
I'm not a lawyer, so I'm happy to talk about one that I was familiar with. But Lauren, that was the perfect answer. That's why you're so good at your job. But I remember this is one where I was involved with a firm. Lauren probably remembers this, but way back there was a reporting issue with mutual funds across countries. They have to provide daily net asset value to trade. And some of the best academic research on this was done here at Yale by my colleague, Will Getzman, who's also going to be teaching in this program, by the way. But they had shown that, so for instance, when the US market closed, right, you would learn what happened to mutual funds that day. And that would spill over to markets that hadn't opened yet the next day, right? So let's say, out east, for instance, you could look at Europe and Japan and the US and play this kind of time lag. And what you could do is you could use the information from the market that had ended that day to predict what was going to happen to prices the next day. And there was a little bit of an arbitrage there in terms of, and I know of an investment firm where they did the research as well. They thought, yeah, we could exploit this. And they decided, not because it wasn't allowed yet, but because they realized this is probably going to be disallowed very shortly. And while you can make a small amount of money in a short period of time, well, let's say a lot of money in a short period of time, but in the grand scheme of things, it's not that much money off this stuff. It wasn't worth what they called the regulatory risk, right? And the political risk of doing this and then having it get shut down, and also being, sort of pointed out as one of the, perpetrators of this kind of thing. Because basically what it was hurting was the ultimate mutual fund investor. So you can think of it as, it's a similar discussion as to what's going on today with high frequency trading. You're sort of front running something that's, you can jump ahead of the queue before investors. It's not really the purpose of that vehicle. And I remember I was deeply involved in those discussions, and the conclusion by the founders of the firm was, you know what, this just has regulation risk all over it. It's not worth us doing it. And so that was a case where a very viable trading strategy was shut down, and even without the regulation, but with the anticipation that this was going to be regulated. And it was, by the way, it was. In fact, my colleague who had done the research, Will Getzman, I think was heavily involved in testifying about why it should be shut down, and it was a very simple way to fix it. And that was one where, regulators relied on some of the research for the best way to do this. So there's one example. I'm sure Lauren has many others, but
oh, that's great.
So, but a great question.
Great. And so another question that came in, let's see here. Oh, this is an interesting one, actually. I'll skip over here. So relating to mutual funds, since BlackRock and Vanguard have become significantly huge among mutual funds indexing, does Professor Kaplan envision regulatory action within mutual funds, especially index funds?
That's a great question. I'm trying to think. I mean, I think what I would have to say on that is just, you know, and one of the things we'll cover in the last portion of the course is this change in kind of concentration of ownership of companies through, you know, things like index funds and big mutual funds, and the fact that, you know, just ownership of companies has changed. If you look at the landscape from, you know, when the original Securities Act was put in place and until now, it's a completely different landscape. And I think there are a lot of implications from those changes that haven't necessarily been completely reflected in the regulations yet. And so there are conversations around, you know, how ownership in companies is calculated. So when you just see BlackRock or, you know, these large holders, but they're, you know, in reality, right, they're holding on behalf of many underlying investors. How do you think about that? What, you know, again, that has kind of knock-on effects on the company side for registration requirements. It has effects on the sort of proxy side of things and voting. So we're going to look at a lot of those issues around index funds and mutual funds and just these larger groups. So I think, you know, from that perspective, we'll talk about that and look at it more broadly. I don't know. It's an interesting area to watch. There's certainly a lot going on there.
Wonderful, thank you. And this is actually a really fantastic kind of last question, I think, to bring us home. So I have a question here that says, should we always expect an ever-changing regulatory environment in the asset management industry? And if so, should we consider regulatory arbitrage as a long-term strategy?
Great question. Well, I think, you know, the first part of the question, should we always expect regulatory change? I think yes, to some extent, because the regulations are reflecting changes in investment ideas, strategies, and tools. And I would expect those to, you know, always be evolving because that's what asset managers do best, right? And what investment managers do is come up with these great new ideas of, you know, ways to invest and tools to use. So, you know, in that sense, yes, the regulations will continue to evolve to match those changes. And you know, the other thing we haven't talked about too much, but, you know, there are a lot of other kind of trends, right? All of these technology changes that are going on, you know, have an impact as well. So the way that investors can get access to, you know, to markets, the sort of incentives that are embedded in the markets. Toby, you mentioned the high frequency trading, the speed of trading, like there are all these big changes that we're seeing going on now that are going to take, I think, quite a while for the regulations to figure out. So, you know, yes, the regulations will keep changing. In terms of regulatory arbitrage, I don't know, again, this is sort of more on the investment side, but, you know, I don't know that that's the regulatory changes, you know, when you're investing, especially institutional investors looking more for the long term, you know, I don't know that you kind of want to think about where the regulations are going and think about your long-term goals and your long-term strategy and how to map all of that together. So I would just say, you know, I think you also see like we were talking about earlier, we're going to have this global perspective because more and more, right, borders aren't as meaningful in markets. And so, you know, those opportunities, there will always be differences, obviously, in different jurisdictions, but I think we're seeing more international cooperation, more more kind of consistency across markets or try for consistency across markets. We're not at all there yet, but just because we're seeing, something happens in the US, but it has an impact everywhere else. Something happens in, like we were talking about, China, or, the Chinese market, or in the EU, it has ripple effects pretty quickly. So I think it's good to keep following the regulations. They'll keep changing. I don't know whether it'd be a strategy to invest around that.
Great, thank you so much for that. And so that concludes our session. I want to thank you both, Lauren, Toby. Thank you so much for being so generous with your time and attention today. I'm really looking forward to sharing this with our audience. Also, everyone, a recording of the session will be available. Thank you both so very much, and I look forward to seeing you around campus and the start of your class this spring.
Great, thanks so much for having me.
Thanks again, Lauren. Thanks, Emily.